Good day, everyone. Welcome to Module 3 of the analysis of the Nigerian Tax Bill. In this module, we will be looking at Chapter 3 of the Nigerian Tax Bill. Now, Chapter 3 of the Nigerian Tax Bill 2024 is a pivotal segment addressing the taxation of income from petroleum operations, a cornerstone of Nigeria's economy. This chapter integrates the tax principle established under the Petroleum Industry Act and aligns them with Nigeria's broader tax framework to ensure equitable, transparent, and efficient taxation of upstream and midstream petroleum activities. Now, this chapter is divided into four key parts covering hydrocarbon tax, petroleum profit tax, deep offshore and inland basin production sharing contracts, and lastly, okay, let me take this again. The chapter is divided into four key parts covering hydrocarbon tax, petroleum profit tax, deep offshore and inland basin production sharing contracts, and miscellaneous provisions. Each part outlines the tax obligations, allowable deductions, and mechanism for revenue sharing, ensuring that petroleum operators contribute fairly to Nigeria's tax base while promoting fiscal stability in the sector. So now let's look at part 1, hydrocarbon tax. We'll be looking at the scope and definitions. Now, hydrocarbon tax applies to companies engaged in upstream petroleum operation across various terrains. Now, onshore, shallow water, and deep offshore areas, it targets specific petroleum products, including crude oil, field condensates, natural gas liquids derived from associated gas. And with the exclusion now, hydrocarbon tax does not apply to natural gas production. So hydrocarbon tax does not apply to natural gas production, which is taxed under different provisions to incentivize its utilization and development. Now, calculation of chargeable profit under hydrocarbon tax. Now, the bill provides detailed procedure for calculating profits subject to hydrocarbon tax, and the steps include revenue determination. Revenue includes sales proceeds from crude oil and related products. Now, adjusted profits. Adjusted profits are calculated by subtracting allowable deductions from total revenue. Assessable profits. Adjusted profits are further refined by excluding disallowed expenses to, for you to be able to get the assessable profit. Now, chargeable profit, the final taxable amount after applying any relief or exemptions. That's the final taxable amount. That is the chargeable profit. Now, let's talk about the allowable deductions. Under the allowable deductions, we have rents, royalties, and repairs directly related to production. Decommissioning contributions to fund the eventual closure of operation is also allowable deduction. Now, for disallowed expenses, we have penalties and fines, financial charges such as interest on loans, contributions to certain funds not approved for tax purposes, and let us also look at tax rates and consolidation. The hydrocarbon tax rates are structured to ensure fairness across different types of petroleum operation. So let's look at it now. The rate is 30% for petroleum mining leases, 15% 15% for other petroleum operations. Then with respect to consolidated provisions, companies may consolidate costs and revenues across specific petroleum assets, reducing administrative complexity and align with best practices. So now we'll move to part 2, which is petroleum profit tax. Now let's look at the application. The petroleum profit tax applies to companies operating under oil prospecting licenses or oil mining leases that have not transitioned to the fiscal terms of the Petroleum Industry Act. Now, under revenue calculation, a company's taxable revenue includes proceeds from sales of chargeable oil, incidental income such as fees or penalties paid by third parties, gains from asset disposal, including machinery or equipment used in petroleum operations. Now, let's look at the allowable deductions. The allowable deductions include incentives for gas utilization projects to encourage diversification, operational expenses directly tied to production. These are the allowable deductions in summary. Now, for disallowed deductions, contributions to funds not aligned with tax purposes, costs incurred in unrelated activities. Now, let's look at the tax rates and losses. So, tax rate and treatment of losses. Now, the base tax rate is set at 85% of chargeable profit for most companies. Special considerations apply to companies that have not fully amortized their pre-production expenses, ensuring fair treatment during the recovery phase. So now the impact of this is that this ensures that high profit companies contribute significantly to national revenue, while companies in their early operational phases are given relief. They are giving relief. So let's move to part 3. Part 3, which we talked about deep offshore and inland basin production sharing contracts. Now, the scope of this is that this part specifically addresses the taxation of contracts in deep offshore and inland basins, areas that require high capital investment but yield significant returns. Now, let's look at the key fiscal term. A 50% petroleum profit tax rate applies to all contracts within this scope for the contract duration. Cost and revenue sharing. The bill establishes a clear framework for allocating production revenue between parties, ensuring transparency and equity. Now, with respect to allocation now, the allocation involves royalty oil, which is paid to the government as compensation for the extraction of natural resources. Cost oil, allocated to cover operational cost of the petroleum company. Tax oil, allocated to settle the petroleum profit tax liability. Profit oil, the remaining revenue shared between the government and the company based on agreed terms. Now, this structure ensures that the government secures its fair share of revenue while incentivizing continued investment in high-risk area. So, part 4, which we'll be looking at miscellaneous provisions. Administration and enforcement. The administration of petroleum taxes, including royalties invested. Okay, let me take that again. Miscellaneous provisions, administration and enforcement. The administration of petroleum taxes, including royalties, is vested in the service. Now, the service here refers to the Nigerian Revenue Service. Now, responsibilities include monitoring compliance with the Nigerian Tax Administration Act, conducting periodic reviews of production sharing contracts to ensure alignment with fiscal terms. Now, clarification and definition. Now, we'll be going to clarification and definition, which is still under the miscellaneous provision. Now, the key terms defined under this part include chargeable oil, crude oil volumes subject to tax. Another definition is the commissioning contributions, which is fund set aside for dismantling operation at the end of the asset's productive life. Profit oil, the portion of revenue allocated as profit after meeting all tax and cost obligations. Now, the purpose of this definition minimize ambiguity, ensuring clarity in the application of tax law. That's the purpose of this definition. So we'll be able to define some certain things here. Now, the analysis and implication of this particular part is that it ensures fair contribution. The hydrocarbon tax and petroleum profit tax framework are designed to ensure that petroleum companies contribute fair share to national revenue, reflecting the profitability of Nigeria's natural resources. Now, number two, under the analysis and implication, this also help with the we're talking about the alignment with the Petroleum Industry Act. This chapter complements the Petroleum Industry Act by incorporating its fiscal principles such as incentives for gas utilization and provisions for decommissioning contribution. Now, number three, incentivizing investment by offering reduced tax rates for deep offshore and inland basin operations. The bill encourages investment in high-risk areas critical to Nigeria's energy security and economic diversification. Number four, promoting transparency. The structured approach to cost and revenue sharing fosters accountability, ensuring that all stakeholders understand their obligation and entitlement. Also, environmental consideration. The inclusion of mandatory decommissioning contributions reflects a commitment to environmental sustainability, ensuring that operators are financially prepared to remediate sites post-production. Now, in conclusion, Chapter 3 of the Nigerian Tax Bill 2024 establishes a robust framework for the taxation of petroleum operations, balancing the need for government revenue with the importance of fostering investment in the Nigeria's oil and gas sector. So, by addressing hydrocarbon tax, petroleum profit tax, and production sharing agreements, the bill ensures a comprehensive approach to taxing upstream operation. Now, the key takeaway here is that the hydrocarbon tax introduces fairness by applying differentiated rates based on operational terrain. Now, petroleum profit tax ensures high profit companies contribute significantly to national revenue. Production sharing contracts offer transparency and equity in revenue distribution. Environmental provisions ensure sustainability in resource extraction. Now, let's look at the call to action for stakeholders. Petroleum companies, investors, and policy makers should review the chapter's provisions carefully to understand their obligations and opportunities. Engaging tax professionals for compliance and strategic planning is also very crucial for navigating the complexity of this chapter effectively. So, the provision in Chapter 3 solidify Nigeria's commitment to a balanced and forward-looking petroleum tax regime. Thank you very much for your attention.